into the webinar talking about how we deal with this with trading during the summer months, which a lot of people sort of dismiss as choppy and lack of volume and all that stuff. Quite frankly, I tend to do very, very well during summer months. That's not so much for me to because I like to brag. I don't like to brag, but I think it's just a great time. People dismiss it. So we'll look at that. We'll look at that in just a minute. So let's talk about the topic today. I really thought that, again, like I said at the beginning of the when we just came on live a few minutes ago, a lot of people tend to dismiss summer as just some sort of a bad time to trade and all that. And there's some merit to it, and I'll talk about it. There's a couple of weeks here and there during the summer where you just don't want to trade. But more or less, it's good. For example, the month of June, a lot of people already write the month of June off. The month of June is a tremendous month to trade. Okay, so is the month of July. There's a week in July that doesn't make any sense, right? And even August, it depends on how you look at it. But August is a good month. Maybe not the second half of August. We'll talk about that in just a few minutes. So let's look at the agenda quickly. But first, we're going to talk about what the attributes of summer markets are. How are they different than the markets that we see, say, from January through May, and then of course the markets in the fall. Then we talk about how we can take advantage of fewer players, and it is a fact that some people literally sit out the summer. Some of the big institutions, or if they don't entirely sit it out, then they will just make less decisions. So they might still be doing stuff, but given the fact that people are sort of, their staff is sort of rotating through the summer in terms of vacation, they're never fully staffed, and which makes it difficult to really make major decisions. And then we're talking about my favorite strategy for summer trading, which I think is going to be very interesting for most people to hear, as again, it's a high probability strategy to really trade through the summer and not get too chopped up. Just an important note, when I talk about swing trading, this is my own definition of swing trading. Of course, lots of definitions exist, and I'm just going to talk about how I define it. Just like the swing trading strategies, there's a lot of swing trading strategies. The ones I'm going to talk about here today are very much my own. Not to say no one else is doing them, but they are the setups are the ones I use as opposed to some sort of textbook. All right, that out of the way. Let's talk about the attributes of summer markets. So we've all heard the thing in the overused phrase of sell in May and go away. I personally don't really believe in that. Obviously, otherwise I wouldn't be having this webinar. I think it's more like sell in May and trade from away. And when I say that, it's really, summer trading. You don't necessarily, a lot of hedge funds, here in the New York area, like some of the traders that don't actually trade from the office, at least not Thursdays and Fridays. So it's a great time to maybe sell some of your core positions down if you have been net long all year. Really tighten up the portfolio to keep your exposure, your long or short exposure, whatever direction you've been leaning in, at a minimum, and really trade. Okay, and then I'm not talking about day trading. I'm really talking about swing trading with defined risk. So you can sleep at night. You can take long weekends at the beach and relax. And that's really what summer's all about. Trading gives you this wonderful, wonderful opportunity of a lifestyle, very much unlike many other professions. So summer I think is really the absolute epitome of that lifestyle, where you can do your job and given the environment, and really only trade basically 3 days a week. In fact, that's all you should be doing. Which is my next point: trading shortened weeks. A lot of people tend to take Mondays off, to take Fridays off. So by the time people get back into the office for the week, it's usually Monday afternoon, Tuesday morning. So until Tuesday, there's a lot less stuff happening, and you've got Tuesday, Wednesday, Thursday essentially being the 3 days to focus on. So again, we have shortened trading weeks, so Tuesday is a wonderful way of playing. So stick to Tuesday and Thursdays and enjoy long weekends. We also have somewhat elevated volatility due to, and here's the thing, somewhat less volume in a regular news flow. Now, when we talk about less volume, and I'll talk about this more in another few slides from here. Less volume. I can tell you, I traded on the sell side of JP Morgan, traded equities. I've traded, I'm sorry, fixed income. I traded equities on the buy side, and the volume myth really is for the individual investors. I don't know how it possibly could matter, unless you're trading size to the point where you could be a hedge fund. Most individuals can't do that just because they need to have a lot of money. Unless you do that, it just doesn't. I don't see how it's an issue. As long as the stock you trade trades 500,000 shares a day, that's what I'd like to focus on. You'd be fine. Now, again, there's a few weeks here and there where that's going to be a little bit more tricky, but then those weeks you can sit out in the summer and just take the whole week off and do something else, like sharpening your trading skills with a book or a course or something. So, at the same time, I think, given the volatility that we tend to have in the summer, and I'm talking about marginal increases in volatility. We don't on average see massive volume spikes during the summer, but it is advisable to decrease size and holding periods, and this gets me into a whole other aspect of summer trading. Summer trading is, like I said before, it's a good time to really focus on trading opportunistic trades, swing trades with defined risk, and targets. In summer, the summer allows you to do that better than any other time, except maybe the early December period, so the first through the second, third week of December. Very similar type of environment. So July 4th and weekend, and actually July 4th week, and then the second half of August is really when you want to stay away. Doesn't make much sense to trade then. It's just there's potentially, arguably, an issue with volume. There may not be enough volume, but it can also get very choppy, right? Now, again, to this there are exceptions. Look at, for example, the second half of August in 2011. I don't know a single trader or hedge fund that was not at their desk then, because we had massive volatility swings and unbelievable trading opportunities for the quick hitters. So it again, but it's just another example of why this sell in May and go away type of thing. It's more of a slogan than anything else. So then the last point is more the psychological aspect. So better weather often leads to better attitude and clearer thinking, and it helps people's attitude. Here we go. Next one. I didn't finish this slide, but so basically, some of the larger players are absent. I think this is for John, who was asking the question about how less volume creates a better market environment. Again, the volume is more important for the big players than for you, but larger players tend to make the market a little more jerky, depending on what they do. Okay, to sort of round this up, imagine if a big player comes in and has to buy, a massive amount of some financial stock quickly for some reason because it had inflows or whatever it is. Okay, that tends to happen less during the summer. So yes, you have a little less volume, but likely it's not going to really affect the market that they're going to become inefficient. Not the U.S. stock market, not the mid and large caps. Okay, and that's what really the focus is on swing trading. That's what all the liquidity is. So this allows for somewhat smoother markets as the huge orders don't jerk around the markets, unless again in things that literally just don't have volume at all. If you want to trade some sort of small or even a mid cap that just doesn't have volume and doesn't have options and all that stuff, then you shouldn't be trading that anyway. Yeah, I guess just don't trade it, right? So less crowded trades offers cleaner and less jerky trades. In other words, if you have a market where less people are piling in with massive orders all the time, you have a bit more of sort of a smoothed out market that tends to react better technically at important support and resistance points. Okay. Also, market makers and anyone else in the market is less prone to try to look at a significant support or resistance point and jack the market through it just to hit the stops out and then take the market back. Less of that during the summer, better trading environment in my humble opinion for that reason. So talk about the favorite strategy. So my favorite strategy for the summer really evolves around trading the S&P 500, NASDAQ 100, and Russell 2000 via the ETFs. I'm an active futures trader, so I do that as well. But from a swing trading point of view, I try to trade the ETFs. So for the S&P 500, it's the SPY, NASDAQ 100 is the QQQ, and Russell 2000 is the IWM. Why? It's a cleaner focus on short-term support and resistance levels that really, like I just said before, makes it attractive. What I focus on is 50% and 61.8% retracements. I'm going to give you a couple examples right now. Just let me finish this slide. We're talking about basic pullbacks in the market, both pullbacks on downtrends or on uptrends at around 50% or 61.8% of a given swing, and we look to buy or sell into those areas.